Thank you everybody for coming today. It means an awful lot, and it's quite a pleasure to have this opportunity. We have a ton to talk about, and the main topic of discussion will be M&A and capital markets as pertaining to the car wash space. So we'll get started. Okay, so I can't quite believe it, but it's been 6.5 years since I founded Car Wash Advisory, and it's been quite a 6.5 years for the industry. A lot has changed. It's a very different industry, which we're going to go through as we dive into a brief history on it. But truth be told, and for level setting for everybody in the room, I had zero business getting involved in this industry. None. I had no family involved in the car wash industry. I had no friends who owned car washes. And if you promise not to tell anybody else, I didn't own a car when I started Car Wash Advisory. And I had never been to a car wash. So don't judge me too hard, but I washed my own car. So nothing said, Harry, you have to go into the car wash industry. In fact, it was quite an uphill battle in many regards. But what drew me to the industry was more so, honestly, a little bit of extra time and a general sort of sense of intrigue. And what started Car Wash Advisory, I'd like to tell you it's because I'm a genius and I saw how profitable these businesses are and how fantastic they are and how much money they make and this boom of private equity that was going to come in. I knew none of that. I actually was exposed to the industry via one of these trade shows and earnestly just fell in love with the people. Down to earth, extremely competent at their disciplines, and just wonderfully authentic human beings. And it just so happened that the businesses themselves were as wonderful as the people are. So before we kind of jump in here, I think it's important to address the elephant in the room, which is that there's a lot of negative headlines surrounding the industry today. There's bankruptcies, there's subpar purchases of large portfolios and companies, and there's extreme levels of discontent and potential concern around performance. If you do think that this is going to be anything like last year in terms of, hey, there's bankruptcies coming, it's not. And I want to tell everybody that here we are 6.5 years later, and all the same reasons why I joined this industry and got involved are truthfully more present and impactful than ever before. So this will not be a doom and gloom story of the industry and all the despair that is to come, but rather a story of what's gonna come next, which is gonna be a lot of incremental progress and a lot of positive movement for the industry as a whole. With that said, we're gonna cover all of this today. So first and foremost, we'll take a brief look at history over the last 6 years and what's gone on in the space to lay that framework. We'll look at the state of the industry as it sits today. We'll dive into M&A. We will certainly touch on everybody's favorite topic, but of course, which is valuations. We'll talk about capital markets and the potential ramifications that nearsightedness may have in terms of the rest of the topics being covered. And then, most important of all, we will absolutely address in full color and detail what's going to happen here over the next couple of years. Okay, so these slides that you're about to see are truthfully kind of wild to look at. So as we go through this presentation, we're going to be framing everything in terms of 2019-22, which is the peak. 2019, excuse me, is the run-up, or the beginning of the run-up, and then 25, where we stand today. And it's wild. It's absolutely wild to look at this stuff. So funny enough, all the way to the left here is the first piece of content I ever published and created in Microsoft PowerPoint for Car Wash Advisory. And it was an image of the private equity's involvement in the space at that time. The whole world, the whole universe of this industry was very different. There were no real large players, but two, one of which no longer exists in its current form, being International Car Wash Group. There were very, very few private equity players in the space, which we're going to delve into further in just a second. There were certainly no publicly traded companies, as we have now with Mr. And in 2019, and it's hard to imagine this, but if you put yourself back into the shoes that we were in at that time, there was no national obsession. It wasn't cool to be involved in car washes. It was going to come very soon, but not at that time. And there was no media attention being given to the industry. We jump 3 years forward here, and all of a sudden, this infographic, which is just an updated version, shows a lot more color, a lot more companies, and a lot more washes. And private equity has built up at this point quite a significance in the industry as a whole. At this point, Mr. is publicly traded. There is nationwide fervor. We're all reading stuff in the Wall Street Journal about car washes, which made no sense and nobody could have foreseen coming. And truthfully, in mid-22, there was absolutely no end in sight. Nobody was predicting a near-term correction or any sort of change in the dynamic that we've all been privy to and experiencing over the years prior. And this brings us to today. This has not been published yet. It'll come out in a couple weeks or whatnot, but this you can't even discern a single logo on. Private equity is here and in full color, and we'll talk about this more in just a second, but it, again, is a very starkly different picture than it was just 3 years prior. And now, for the first time, it's not all up and to the right? It's not. It's movement in all directions. We have divestitures, we have partial acquisitions, we have some spinoffs occurring, we have bankruptcies, we have new entrants coming into the space buying first-time platforms, but it's no longer unilaterally up and to the right in the proverbial sense. It's all over the place. The majority of the industry is private equity backed. There is absolutely known stress in many of the larger operators, and there's a general looming level of uncertainty and an undeniable objective level of slowdown, especially when it comes to transactional volume. So this is wild. You would think that this was maybe decades. It's not, it's 6 years. So looking at it a different way and focusing in on that sort of sense of private equity's ownership in this space, and this is actually a little mind-boggling. In 2019, the documented ownership percentage of private equity in the high volume, call it plus 100,000 car express exterior market of the US by site count was 13%. Nothing to scoff at, but far, far, far from a majority. 3 years later, and my goodness, we have quite a bit of growth. We nearly doubled that stake in 3 years. That's significant. And that's exactly what was reflected in the infographic on the prior slide. What's crazy is this. In today's world, 61% of the high volume express exterior market is owned by private equity and institutional investors. That is not even close to the 13% that we had 5 years ago. They are officially the majority and undeniably so. It's wild that all this could transpire in 6 years' time. And it's not all bad, and we're going to talk about private equity's influence, and private equity in many ways had more profoundly positive effects than negative despite recent headlines. But just this graphic alone should be quite sobering in terms of just how much everything's changed in so little time. 3 years, 20% to 60%. But that's not all that has changed over the last 6 years, not even close. So in 2019, as I mentioned, the private equity groups, they rise into the full force that they are becoming. And we see a absolutely commiserate surge in M&A activity, which we'll go into in the next section. All of a sudden, sale-leasebacks become commonplace and almost expected throughout the industry, whereas 5 years prior thereto, they were unheard of in the industry. And then as we reached our very, very peak, and we'll talk a bit more about this later, the equilibrium that exists between new build economics and that of M&A shifts drastically and quite violently towards favoring new builds over that of M&A. Then we enter the dark ages, if you will, and 23 rolls around, and all of a sudden people are less worried about growing site count, but we're worried about density. Which brings us to sort of where we are today, which is a absolutely astronomical level of slowdown across the board. And we'll go right into this, but this is today. So Keep all of this in mind. In 6 years, the entire industry has changed so dramatically that you'd be forgiven if you thought it was a different industry today than it was 5 years ago. So here's what I want to talk about. As we go through today and where the industry currently stands today in today's world, I don't want to talk about it in terms of generalities. I'd rather talk about it in terms of framing it around questions that are the most topical, most meaningful, and most commonly requested and asked about. And hopefully this will kind of set the stage in a more significant manner than talking in generalities. So, with that being said, the first question that is commonly asked is the market saturated or is there white space available? This isn't a conversation to be had anymore. There's 1,500 different ways to measure saturation in an academic sense. And you can use whatever formulas and whatever covariables you want, doesn't matter. The answer is really, really simple. No, the market is not saturated. Yes, you have to be careful about where you're building sites and not be a moron about it. Go figure. But no, in no way, shape, or form, and in no measure, metric, calculation, or methodology can anybody arrive to a point of saying the market in the United States for express exterior car washes, is saturated today. It is not. As to where that white space exists, that's a different conversation and certainly outside the purview of this conversation, but it's not saturated. Next, we're going to talk about fragmentation. Everybody asks, where are we in terms of this sort of pendulum between, is it a fragmented industry or is it a consolidated industry? And there's a funny element to fragmentation and consolidation because it really all matters about in what lens you're viewing consolidation from. If you are KKR owning Quick Quack, your view or scope in which you try to determine consolidation versus fragmentation is awfully different than that of a single or a two-site operator trying to figure out if there's room to grow in your local market. So as we walk through these numbers here, I think it's important to realize that fragmentation and consolidation mean different things to different parties. But even with that said, let's talk some hard numbers here. I think the only number anybody in the industry can actually agree on is that there's about 60,000 car washes, which is the most meaningless number anybody could ever rely on in any sense. It's absolutely nonsensical and meaningless. If we drill one step further, we've got about 30,000 conveyorized car washes in the country. Less contended than the points to come, but still rather meaningless. And here are the two numbers that really matter. So there are roughly 10,000 express exterior car washes in the country. Of those 10,000, generously speaking, but only 7,000 in the whole country would be qualified as doing over 100,000 cars a year in volume. And the reason that sort of barometer or line in the sand exists and is excruciatingly important is because when you're looking at the industry from the lens of investors, investment, institutional groups, if it's not going to be capable of washing over 100,000 cars, and this bar is pretty low, an argument can be made it should be higher than this, therefore reducing that 7,000, it's not in the industry that they're really looking at for all intents and purposes. It's not an investable asset. It's not part of the total addressable market in any sort of meaningful way. So that seems like a lot less than everybody talks about, and it's certainly a far cry from 60,000. Most definitely it is. But what's even more interesting is if you go ahead and you extrapolate that to look at, well, okay, what if we divide it among the companies that have 10 or more washes? Okay, so we're dealing with a denominator of 7,000 high-volume express exteriors in the country. 5,500 of those 7,000 are owned by operations with 10 or more sites, leaving the remainder of 1,500 washes. If you assume that the average remainder owner owns 3 sites, which is generous in terms of the point being made, there are 500 identifiable targets in the entire United States yet to be consolidated or bought that are worth going after in the high volume express exterior market. And that's a number to sit with and to noodle on because you can look at it through a couple different ways. I think the most immediately meaningful to me is to say, okay, so that's what? 10 per state? Honestly, even that sounds generous. Point being is the market is still fragmented, most surely it is. But in terms of it being completely unconsolidated, no, it's not completely unconsolidated. The question becomes, where does the consolidation top off? And that's what we're really going to dive into later in the presentation in terms of looking forward and what to expect. This is the best question. And it's so funny to me that this constantly gets asked now, even though the fundamentals of the industry itself haven't changed much. But in terms of framing today in the landscape that we're in, one begs the question of, hey, is this car wash stuff still worth investing in, still worth looking at? Is it worth building the next site? Well, why don't we take a look at what made car washing so attractive in the first place from the external lens? Well, profit margins and cash flow margins, those certainly haven't changed. And if anything, they've actually gotten more favorable. How about the predictability aspect and the ability to forecast your revenue and your future performance? Well, with the proliferation of membership being what it is, it's gotten nothing but more attractive and better. How about, this one's an interesting one, how about seismic threats? So in today's world, not to get too existential and meaningless for everybody, but it's very far and few between that you run across an industry that truthfully has no overhanging, looming, sort of threat of death to the industry, whether it be by AI, whether it be by outsourcing, whether it be by a new technology. Newsflash for everybody, nobody's developing a polymer for car paint that does not require washing. There's actually no sort of exogenous threat that is looming over the industry. So yeah, it's still attractive in that way, most certainly. And this is the least talked about and probably the most important point in terms of the industry's attractiveness as it stands today. If there has been one truth that should have gotten more attention and hasn't in the industry, if you ask me, it is that all this capital poured into the industry as fast as it could be poured. And what didn't was the human capital, because there's no way to rush that. This is a apprenticeship type industry and business for which time cannot be rushed or accelerated beyond that of what's necessary by way of training and lessons learned. Today, in 2025, the industry has the smallest gap between the human capital required and the invested capital that's poured in. So of all these 4 points, not a single one has diminished in terms of its effectiveness or attractiveness, drawing money and drawing investment and drawing growth into the industry. So this will probably be everybody's favorite topic, and I'm sure this is where the Q&A will focus, but the last question I want to go through in terms of framing where the industry is today is by answering the question of whether or not it's all falling apart. And goodness knows there's been some headlines recently that draw concern, and rightfully so, I get it, and optics can be awfully deceiving. And quite frankly, by reading through certain companies' bankruptcy declarations, I would be far to blame anybody from drawing completely and utterly incorrect solutions or conclusions, as to what's going on here in the industry. So Zips and Take 5. On one hand, we have Zips. Zips is officially bankrupt. They should soon be coming out of bankruptcy. Take 5, on the other hand, no, they're not bankrupt. They got bought by Whistle Express, but they got bought for a mere fraction of replacement cost or what they had into it. And I think the best way to sort of walk through what actually happened and transpired with these two companies by way of example is to compare them to the other operators in the space. And I think the read through here is going to be quite profound, I think. So first and foremost, sale leasebacks. We mentioned them earlier in the presentation, and here they are again. Both Zips and Take 5 were absolute users of sale leasebacks to any and all extents possible by way of off-balance sheet financing and their sources of capital for growth. Note, other operators also use sale leasebacks. Okay, so interesting, but that certainly can't be the only reason why these guys got themselves into maybe the situations that they did. How about some scaling difficulties? And I think these guys don't get nearly enough credit for the fact that they've done what other people have never done. Mr. is sitting here with a 50-plus year history being at 500 sites, and any which way you cut it, Zips and Take 5 did what took Mr. decades in but years. So yes, there were scaling difficulties. Are those scaling difficulties unique to those two companies? No, certainly not. Other operators also experienced those scaling difficulties. Harry, this doesn't make much sense, and this is not very meaningful because it seems like every trial and tribulation that one could go ahead and apply to these two companies were experienced by other operators, and that's fair. This is possibly the most sort of pejorative of everything, which is growth for growth's sake. And what I mean by this is, I think we all can suffer from times of overexuberance on a personal and a company basis, and Zips and Take 5 were certainly guilty of that, as were many other operators. And to clarify that a bit further, what I mean is maybe sites were bought that shouldn't have been bought, and maybe sites were built that shouldn't have been built, okay? But again, nothing other operators didn't experience. And last but not least, one can absolutely point their finger to maybe some outpacing of growth by way of comparison to the operational sort of aspect of the business. So maybe operations were let go. All right, that's fair. We've all heard stories. We've all seen sites that are less than perfectly managed. But once again, other operators also experience this. So at this point in time, everybody should be saying, Harry, you're a moron, get off stage. This is the stupidest slide I've ever seen in my life, and it teaches me nothing. For which you're kind of right, except I think it's important to pause and just recognize the level of forgiveness that the car wash industry affords to both investors and operators alike is absurd and unfounded compared to any other industry. The margins themselves insulate you from so many compounding mistakes that you can make on top of each other. It's not until you make, I don't know if this thing works, it's not until you make all these mistakes that anything comes to be in terms of a day of reckoning. And this was all with sort of some macroeconomic factors and whatnot. But the point being is a lot of companies maybe had scaling difficulties and grew for growth's sake, but maybe they were less heavy in the sale leasebacks. And maybe some guys didn't keep an eye on operations and grew a little too fast, but they actually didn't grow for growth's sake itself. It wasn't but the combination and the culmination of all of these occurring at the same time that caused the situations we have today with these two companies. So I think the best way to sort of sum up, and we can talk way more about this during the Q&A, but the best way to sum up what happened to Take 5 and what happened to Zips is they grew faster than the market conditions were giving to them in terms of forgiveness. And to that, I don't think much blame can be laid, and I think there might be an incorrect narrative being formed around what happened with these companies. One last point I do want to make sure to bring up before moving on. And for anybody who read the declarations, the bankruptcy declarations for Zips, the entire thing was focused on what I'm about to say. Overbuilding, well, we didn't mention that once. How about interest rates? Yeah, 2% interest rates are going to break a company with 55% consolidated margins. That makes sense. How about consumer softness in terms of spending? No, we didn't mention that either. No, because none of those were the reason why we had difficulty with these two companies. It was not interest rates, it was not consumer softness, and it was not overbuilding. It was individualized company level attributes. And if anybody wants to walk away from this with one thing, if there's one thing I could leave you with, Zips and Take 5 are not indicative of the industry. Period, point blank, end of conversation. They are not. What got them into the situations they are in today is what they did, not what's happening to the industry. So, taking a breath here and looking back on this, is the industry falling apart? No, it's not falling apart. And in fact, it's actually quite progressive. So this is my favorite graph. It's probably the coolest graphic you've seen in a while. I get it. It looks all doom and gloom. This is actually my favorite graphic ever. And I'll send, anybody who wants this presentation, let me know. But this is ripped out of Ray Dalio's Principles book. And it's to show that although you might be in a period of what seems to be decline, despair, gloom, and doom, In fact, what you're doing is you're making stumbles and trips that will allow you to build further into progress over time. And quite frankly, I think Zips and Take 5 deserve a lot of credit for progressing the industry to where it is today and falling on the sword by way of lessons learned. And the only thing that's going to come of all this, for everybody who thinks that this is the end of the industry or an apocalypse of sorts, because it's not, is progress and learning and improvement, and we're going to iterate again. So, where is the car wash industry today? Is there white space, or is it completely saturated? It is not saturated, there is white space. Is it fragmented? Yes, it's still fragmented, and that is regardless of through which lens you look at it from, whether you are a mid-sized private equity group, a large-scale consolidator, or an individual owner-operator. Is it attractive? Yeah, it's not only attractive, it's more attractive than it's ever been. None of that has changed. And no, it is not falling apart, unequivocally. So here we talk about M&A, which is why everybody came here today. So the first way we're going to look at mergers and acquisitions in the space over the last 6 years is through the simplest of lenses, which is that of how many deals are being done. So what you see on the screen here is deal volume over the years for car wash transactions, with 2025 being grossed up for the whole year from what we've seen year to date. This graph alone is probably the best visual from this entire presentation, because what's awfully unfortunate and very aggravating for anybody who's dealt with data interpretation before is it's very often the case that it's hard to interpret a true meaning from data. I can assure you it's not hard to interpret a meaning from this graph. It's pretty clear. And it's pretty stark. So we see the run-up from 2019 through 22, and then we see a complete violent reversion back to steady state prior to the run-up. This is, pretty self-explanatory in terms of people buying, and then maybe things tightened up, interest rates went up, let's look at some stupid, naive metrics, and we'll blame it on that. Fine, okay. So just keep in mind as we continue going through this M&A section, all the while these M&A transactions are increasing in proliferation, so are new builds, and that's important to realize. And yes, interest rates did rise in 22. There were definitely less targets, which we'll talk about more in depth in just a second. Valuation expectations for any buyer in the room, I'm sure you experienced this. Nobody was shy about talking about needing 15 times to consider an offer. And now today, there's some concern around distress, and for good reason. There are companies in bankruptcy, and there are companies being bought for pennies on the dollar. But this is half the picture. The other half, which I think actually paints the holistic image of what we should all keep in mind and the full story at hand, is if you actually bifurcate that or take a different sort of cut of the data to look at not number of deals, but rather, how about sites? How about how many car wash sites were acquired by year? And how about, more importantly, this blue line, the light blue line, is the average number of sites acquired per M&A deal in the car wash space over the last 6 years. And if you ignore the right side of the graph to start, well, the story makes a lot of sense, because my bumbling, self up here saying, hey, we bought until we couldn't buy anymore, and presumably people want to buy the best and the biggest to start. Why wouldn't you? Everybody does. That makes sense. Maybe we're buying 14 sites on average to start, and then by the time we get to 22, there aren't so many big packages worth buying. So we're buying 5-site packages. Okay, I'll buy it. But then tell me, Harry, what is this run-up? What is this complete and utter linear reverse in the trend that we're seeing? Why are site counts per acquisition going up every year since we hit the bottom? Well, it begs a lot of questions, and it's not a singular element to all of this, but there's a couple things going on. One of the things is that this level of looming concern around performance, which really a light was shined upon this entire situation with covenants, debt constraints, and the rising of interest rates. So if anything, it caused for an optical reinvestigation into the performance and people sharpening their pencils, if you will. that caused some concern. And with that, we saw a lot of new entrants come into the space, which at this point in time, because of the new scrutiny being put on not by everything, but by only buy what is worth buying, those happen to be the larger packages. The other element going on here, and why we're able to increase average sites per transaction during the downfall, if you will, or the correction or reversion, is that remember when we were over here, all the way during the run-up, new builds were reaching all-time highs. And that's okay, that's great, that's fantastic for the industry. And as we discussed earlier, it's not saturated, terrific. But during the years when they're built, and especially when people are now taking out their proverbial magnifying glasses to say, hey, does 2 + 2 really equal 5? Well, I'm not buying pre-revenue sites, I'm not buying pre-profitable sites, I'm not buying early stage sites, and I'm not paying you for those sites based on pro forma. So it took a while for those builds that were occurring during the run-up to get to critical mass to allow for them to be acquired on the tail. And that's exactly what we're seeing here. So this, let's go to the next. Sorry, bear with me, everyone. All right, so let's put these two next to each other, and that's the entire story. And it can be interpreted, told, and the narrative is clear as to what happened to this industry. And again, I want to just point out, this is not, oh, I guess I could see it type data. This data is resoundingly clear. For the record, one last point I want to bring up on this, that 12, whoa. Bear with me. Okay, so that 12 all the way to the right, that is without take 5 whistle. So don't be mistaken that the data was sort of massaged to tell a story. It was not. The site count is still rising per deal, even taking out the one huge outlier that would skew this up to, my memory serves, 30 would be the average, not 12 with take 5 taken into account. So before we move on to the next section, because we will circle back to this in the end, it's wild. In 6 years' time, we've seen what seems to be almost a full cycle in an entire industry. Normally, it doesn't happen this quickly, and normally it doesn't happen this starkly. But it's not a full cycle. There's one leg left, which is going to be the last portion of this presentation. And then we'll go full circle, and Ouroboros will eat its tail, and we will be back to the starting line. But for now, we're not actually done with a full cycle. So we are on to everybody's favorite topic, as I mentioned in the beginning, valuations, and we'll circle back to the other stuff at the end. But valuations, everybody always wants to talk about. And valuations are also the most dangerous topic to discuss in a broad and a large group setting because there's so much of an individualized aspect of valuation, and there's so much misinformation around people comparing true apples to oranges. Whether it be real estate owned and real estate being leased, whether it be 1 year forward based or LTM, whether it be that a portfolio has half of their sites as unbuilt development lots and people applying naive multiples across the board or dollar per site figures to compare transactions. By far the most dangerous topic here that we're going to be talking about, but we'll talk about it. And we're going to talk about it in a kind of unusual way. And I promise we will get to the hard numbers and just next after this. But before we get to hard valuation numbers, I think it's remarkably important that we talk about it from a simple perspective as to what's really going on, because everybody thinks that the sky is falling, valuations are nowhere near where they were, and that makes sense because there's so much going on in the industry in terms of bad headlines, negative news, etc. But I urge you to kind of take a more high-level view of valuations, and this is where you can see my wonderful artwork and terrible interpretation skills, but this is how I view it, and I think these are the real dynamics at hand. So over recent times, concern over performance, as we've discussed time and time again here, has increased, and for good reason. Not ubiquitously and not indiscriminately on all car washes. That would be absurd, unfitting, and uncouth. But in this instance of general, naive, outside perspective, we've seen that concern of performance of the industry results in lower valuations. Great, cool. But what about this whole thing about there being less targets? What about all that run-up in M&A activity? What about if we go back and we talk to our Econ 101 professors? What happens when the supply of target assets shrink and shrink and shrink and go the other way? Certainly, scarcity among the assets of desirability would combat this concern over performance, would it not? And due to this, and this push and pull, whereas everybody thinks valuations have absolutely plummeted, I will make a very, I suppose, contentious argument that between misinformation as to where valuations ever were, as well as sort of where they are today, the drop that everybody talks about did not happen. It never happened. And in fact, all these absolute nonsensical and meaningless numbers that were once discussed in the 22 times range, I encourage everybody to sort of read in between the lines on those, because they weren't plain vanilla deals at 22 times. What has happened is liquidity has shrunk drastically. And that's most or best exemplified by the M&A volume graph. There's no denying that when you go from 160 transactions to 40, there's less liquidity. Valuations, though, haven't shrunk all that much. So, because I know everybody wants to look at hard numbers, and we will do that at risk of being yelled at or, this being thrown back in my face by many people, we're going to do this. So I want to constrain the conversation, though, to not be every permutation you can imagine. This is not going to apply to 3-site packages without real estate. It's not going to apply to new development sites. It's not going to apply to portfolios of 50 with 10 new developments and 20 of them are owned land and 30 are not. No, we're going to try to constrain this view and get a meaningful, thematic, but hard number-based image of where valuations in the industry have been and where they're going. So, for the point of this graph, we are going to be focused entirely and only on real estate-owned, express exterior car washes that are high volume, doing over 100,000 cars or more a year with 5 to 20 sites. And this non-temporally weighted graph, meaning every time period represented here is given equal space on the screen, is in a way potentially misleading, but we can talk about that. But this is valuations, guys. This is the whole story. Nowhere on this will you see 22 times. Again, we're talking about 5 to 20 site packages. And there's two things that I think, as everybody looks at this, that they should draw as a conclusion. One is obvious, one is less obvious. The first is that the variance between top and bottom has grown consistently. So we went from a 1 multiple disparity to a 3, and then eventually to a 4. And the reason for this is actually quite important, which is that whereas the industry was buying everything and anything that they could get their hands on to start just about 5 years ago, all the way up until 3 years ago, now the level of discernment being put in place as to what should be bought for any price, let alone a price that makes sense, is infinitely higher and more scrutinizing than ever before. And due to that, that disparity is growing. And then the other point I want to make sure everybody walks away with is that we are still closer to the top than the bottom. And from that, you can draw whatever conclusions and whatever meaning you want. If you want to be the bear in the room and say, no, this is a falling knife situation, well, then in that case, there's plenty more to fall. However, if you want to look at it as a glass half full, or maybe your thesis lies in a different direction, just objectively speaking, we still are closer to the top than we are the bottom. I mentioned one point before moving on that I think would be foolish to not dive into just a touch deeper here, which is that there's no temporal weighting on this graph. Every time period is given equal space on the screen. That's very misrepresentative and very dangerous, because pre-2019 is a very long time period. So I urge everybody in their heads to just think through what this would actually look like if you did extrapolate it over time. We had valuations sitting at 5 to 6 times for the majority of history of the industry. This that we're showing here has been a recency. It is not where the industry has been for decades. Okay, so we'll move to capital markets, specifically debt capital markets, and as it pertains to everything we're discussing here, because it will have ramifications on the future. We're gonna look at it through the same lens and scope as we did that of the industry, the state of the industry, the history, all of it. So we're gonna look at 2019, 2022, and 2025. So when you think about creditors and debt providers in the car wash industry, before the run-up, and anybody in the industry in the audience who has been in the industry longer than or earlier than 2019 knows this, lenders don't like car washes. They never liked car washes. They're single-use properties, they're specialty purpose, there's no residual value, they cannot be turned into anything else, they're highly operator dependent. By and large, if not for the specific operators getting that loan, banks don't like car washes. And that was always the case. What's crazy is it wasn't long thereafter where everything completely changed, as I get this to work, yes, and all of a sudden it was easier to get money in this space than it should have been. And this caused a huge, I won't even say a problem, but it accelerated faults that the industry had in terms of maybe cracks in the foundation. But everybody could get any debt, any equity, any sort of financing you wanted. There was a price for it, but it was available. And here we are today, and what we're seeing on our end, what we're seeing on our end is that we're seeing reversion very quickly, and as quick as we saw this sort of change towards the 22 state, of lenders no longer liking or being attracted to car washes anymore. And if there's one risk outside of the kernel of operations of the car wash industry that we face as an industry for continued growth moving forward, it's that the credit story is unwilling to open their eyes to operator level dependence and the difference between Connor's car washes and Joe's car washes. Because there is a difference, and that's really the credit that should be underwritten. One more topic I want to cover by way of the capital market side of things, which I think is never really spoken about, and everybody kind of shies away from this, but I'd like to maybe put us all into the shoes of a lender for a second. So when you're looking at all of this, and I'm talking about large credit facilities and small SBA lenders all alike, when you're looking at a credit, you're going to say to yourself, well, okay, on an absolute basis, how does the industry reflect in terms of macroeconomic factors, such as consumer spending and interest rates, and how does it look in terms of or compare to industry-specific factors, such as core threats to the model, that seismic threat argument, and competition and saturation, are we at a peak? So if you look at this and you say, okay, where do car washes fall here? Well, car washes are not completely insulated from consumer spending changes, nor are they insulated from interest rates, although I will make an argument the arrow should be smaller on interest rates. I'm pretty sick of that argument. It's ridiculous. How about the industry-specific factors? Well, the core model is stronger than ever with no seismic threats, and the competition and saturation, as we went through earlier in this presentation, is sitting at a place where the industry is not saturated. So these are all, okay, I guess it could become saturated, which is why we have the up-down. And this is, at this point, you're saying to yourself, okay, I mean, I guess it's a little bit better than the average lending opportunity. But what happens when you layer on an entirely new viewpoint, which is based on, which what nobody talks about very often, there's a fixed quantum of capital that needs to be deployed by way of institutional investors. They will take the money out of their pockets and they will spend it. Their question is capital allocation. And when looking at capital allocation, it's not, should we invest in this company? It's, is this company a better investment than this company, or this industry versus that industry? And in doing so, car washes outperform on every single basis. They're more defensive, they have less industry-specific threats. On paper, credit for the car wash industry should not be tightening. So then, Harry, why are you screaming at us about this being such a sort of existential threat to the industry moving forward? Because this assumes that lenders are rational beings, and they're not. They're far, far, far from it. So what I'm sort of hoping for, and what we should all be hoping for, is that the credit story improves to a point where people are actually having some neurons fire inside of their skulls and not being complete nimrods for the next couple of years, and realize how good this industry is, because it is fantastic. And on a relative basis, I'm hard-pressed to find a better industry. But I do recognize, and we should all recognize, that we're fighting an uphill battle here. Zips and Take 5 on surface level, especially with stuff like the Zips declarations, which points to oversaturation, overbuilding, interest rates, and consumer softness as being the reasons this industry is unattractive, does nothing but hurt the entire industry as a whole. This is the story that everybody talking to lenders, creditors, or equity investors should really be portraying, because it's the truth. Okay, most fun part of the presentation. How are we on time? Okay, so what does all of this mean? So here's what we're going to see in the years to come. This is, call it, in the next 5 years. We're going to see a continued and an increased focus on the pruning of portfolios, which is really the doubling down of operational excellence. There will be consolidation among the consolidators. New builds are going to be continuing on a very slow pace. And there's going to be a continued small operator viability element to the industry. And we'll go through each of these in detail right now, because this is the most important part of all of this. So the pruning of portfolios, what do I mean by this? I mean by this very wonderful graphic up in the top right corner, that if Splash Car Wash owns 10 sites in one location, and Go Car Wash owns 1 in that same sort of geography, and vice versa in another, well, maybe it makes sense to kind of swap those sites. Maybe it makes sense to kind of shed away your least performing sites that are not accretive to the company as a whole. And we've seen this. It's already started. Why? Why is there such focus on this? Well, there's the naive and immediately visible sort of ramifications, being that if you have a shared cost basis, and even the sort of naive stuff like, hey, it's great to have more sites in one location so that we can go ahead and pitch that you can wash at any of our 9 sites, fine, fair. But there's also a second degree of ramifications as to why this is so very important. People are realizing, and we very, very, very briefly touched on it earlier, this human capital element, and I cannot stress that although this is not the topic of this conversation, the most important part of this industry is the human capital, and it's slept on, totally inappropriately. But people are finally giving credence to the fact that if you are fighting and vying over that same fixed talent pool within a locale, you are doing yourself and your competitors no benefit in doing so. And you also have ramifications on company culture. So the result of this being a thematic that we're going to see over the next couple of years, go figure, more transactions, who knows what they're going to take in terms of the manifestation, size, quality, and quantity, but we're also going to see that the strong sort of fortify themselves and get stronger through doing this. So we do believe that we're going to see a lot of this by the end of this year, and we do believe that it's going to continue at least through 27, but probably through 30. Oh, sorry. Okay. This is by far the most fun slide of the show. Consolidation among the consolidators. The term that if I hear more, I will quite visibly throw up, because it's been talked about now for maybe 5 or 6 years, nonstop. But we are finally seeing it, and it's taking sort of odd forms. Most notably, you have the option of what Whistle is doing, which is taking down entire companies of mass size. This would be equivalent to Mr. buying QuickBack, QuickBack buying Mr., Whistle buying Take 5, Zips is out of the picture, but these are monstrous transactions. We're talking about top 5 companies in the space taking each other over. It's huge. But there's another option here. So that's one option. The other option, which is in the lower right-hand corner, is maybe it doesn't take the form of one swallowing the other. Maybe in the proverbial sense, we create a Frankenstein. Maybe all of a sudden these companies kind of piece certain geographies off, certain pieces off, certain components off, and they slap them on each other. And that'll happen. But no matter which way you cut it, and no matter what forms it takes to what extent, it is happening, and it's happening today. It's no longer a conversation of theoretics, it's a conversation of tangibility. One point that cannot be said enough, the consolidation among the consolidators, is a heck of a lot easier when one of the two parties is dying. It becomes a whole different equation when they're both formidable predators. The Take 5 Whistle transaction was quite literally the manifestation of a dead prey and a predator. And that makes sense. And I don't use predator in a negative sense at all, but it makes sense. The strong can eat the weak. That's good, that's evolution, that's how we all make progress in this world. But if you have two strong players and somebody tries to swallow somebody who put up a fight, the result is often different. So what do we not know about this? As I mentioned, we don't know how long this lasts. We don't know the staying power of the resulting transactions and companies that come out of this. And we don't know what sort of form it's going to take. But we do know that in the interim, this also increases transaction volume. This is my most boring slide. I don't think anybody should be surprised by this. New builds are not going up anytime soon, right? We've seen the run-up in cost. They were ridiculous in many worlds, over the last 3 years, and now we have tariffs. We also have saturation fears. Whether or not they're warranted, unwarranted, grounded, or not, it doesn't matter. And this graph over here shows what I mentioned earlier in the presentation, which is that there is absolutely an inverse correlation between M&A builds, or M&A and new builds, excuse me. So if new builds are slow, M&A is up. Everything is M&A is up. I don't know if that's going to be the case, but that's what everything points to. Okay, so last sort of theme that I think is least talked about, most important part about this whole industry and affects everybody in the room, especially smaller operators, is this industry really still viable for new operators? Let's say even you sold your sites and now maybe you're thinking, hey, I actually really liked that, I want to do it again. The answer is yes. And this is what makes this industry so fantastically different than any other industry you can find. Whereas other industries, and you name it, self-storage, collision, dealerships, multi-family, it doesn't matter. Name whatever you want. There comes a point, whether it be the cost of capital, the cost of input goods, the cost of something that somebody's paying for to a large extent, that they get discounted to a point where they can run you out of business. That does not exist in car wash and never will, because the only real item that hits your bottom line is your labor, and you can't split people apart. So for anybody who's considering looking at the space and saying, oh, I don't know, maybe it's gotten too out of whack with these big operators, you can absolutely and forever always compete with a big operator. I'll tell you what, I don't care if there's a 2,000 site operator, they're not carrying buckets of water from Idaho to Montana or from Florida to Texas. They're not saving costs. Now, at some point, maybe they can absorb losses for a time period that'll run you out of business, but we have yet to see that, and that would require a reversion to like the $3 car wash days, which I don't see coming back anytime soon. So this industry still does remain just as viable as it was prior to the run-up as it does today, as long as all else equal in a vacuum, you're picking sites that should be built and paying prices that should be paid. So maybe some things do last forever. All right, I think we're close on time. So here is the industry today. This is by site count, high volume, express exterior part of the industry. 7% lies in owners with less than 5 sites, 25% 5 to 25 sites, another 25% in 25 to 100, and then roughly 45% lies in the plus 100. So the question that we're all faced with today, and will be continued to faced with moving forward, is what is this going to look like at the end of 2030? Well, one option is like this. That's pretty much the easy answer, right? Harry, but certainly the big will just keep acquiring and the big get bigger and the small become depleted. Okay, I can see it, I understand it, but the main driving factor that causes this to be an inevitability in most other industries is what doesn't exist in this space. It is what causes an individual owner-operator to not be viable against the big players. But as we just went over, that's not necessarily the case and never will be. That's not how car washes work fundamentally as an industry. So who's to say it doesn't look like this? Now, I'm not going to say I know one way or another which way it ends up, but I can tell you that from any sort of multivariable simulation you run, it doesn't end up like it does in the top. The drivers aren't there. Question is, how long does it hang out up there? So anyways, this is the largest question we're all faced with. Hopefully all of these pieces and parts contribute to everybody having a better idea, but I do want to make sure that we have time for questions. What else is here? Yes, so quick note, I'm Harry Caruso, I'm the founder of Car Wash Advisory. We are a sell-side investment bank focused exclusively and solely on the car wash industry, focused primarily on the $25 to $500 million deal size range. This is all we do every day. If you have questions, concerns, even if you're not within that applicable market, you can literally call or text me or email me anytime. That's all I have. I can't thank everybody enough for being here, and I guess now we can open up to questions. Yeah. I don't know how this works, so just scream.
Your last slide there, what does that say to opportunities for other companies to go public? By 2030, if you see a decline in the bigger players in the market.
Depends on whether or not Mr. Car Wash gets taken private. I'm not going to be going out on a limb, I don't think, and saying that the whole industry would see a benefit from Mr. Car Wash going private. However, it would in many ways and most probably block a public market exit for another player for quite some time.
You touched on the bonus depreciation and how that affects market trends.
Yes, certainly. So the bonus depreciation, I think, is a red herring. I don't think it's enough to drive investment to or from the space. I think it's a bonus, but it's in many ways I view akin to leverage. So if a fundamental thesis does not work because of capital markets and interest rates, then it probably shouldn't have been done. If it doesn't work because of bonus depreciation not being present, you're probably in the wrong industry.
Harry, so I noticed that you didn't touch base on so do you see private equity pulling back from car wash acquisitions as building costs go up on debt services and operational challenges start favoring experienced owner operators over real estate driven models? I guess my question is, I didn't notice that you've talked more on the debt services aspect of this.
Yeah, debt service isn't a factor. And I know everybody hates this answer, but I'll argue with anybody until I'm blue in the face on it. Debt service does not sink a promising car wash venture. This industry is one of far and few between that we are afforded margins to the point where interest rates do not matter. You have more fundamental problems underlying if you cannot make a otherwise 55% adjusted cash flow margin absorb 2% of interest. So I understand it's the scapegoat everybody likes to take, but there's fundamental issues underlying anybody who's going to have trouble due to interest rates.
You talked a lot about the site selection. You want to be investing, you want to be picking sites that are profitable sites. When you're advising on a transaction, how do you know how the car wash company in question compares to its local peers in a local business? Like, are they the biggest player in town? Are they growing? Are they shrinking? How do you know?
Yeah, so we're in this weird, I don't know if I'm echoing, so I apologize, but we're in this weird sort of state of data availability where there's a lot that you can look at, but it's a lot of noise, right? So you can use the Placer AI stuff, you can use all of this to try to proxy into volumes. I don't think anybody's gonna like this answer except for the guys that's been in the industry over 30 years. You go and you count cars. Count cars for a day and you know exactly what your competitors are doing. It's not hard. You can hire somebody from TaskRabbit and it's pretty, simple stuff to do. I think that's it. All right, well, thank you, everybody.